A single order worth $10 billion, a switch chip moving 102.4 terabits per second, and a company you rarely see on stage quietly wiring the brains of the AI era, but not a GPU maker. If you've been watching the AI build-out, you've seen one name keep flashing across earnings calls, product roadmaps, and Wall Street notes: Broadcom, the architect behind the racks, the fabric, and the control plane. Fresh off strong quarters and a once-in-a-generation acquisition, the company is positioning itself not just as a chip designer, but as a core supplier of the infrastructure that makes modern AI possible. If AI is the new gold rush, Broadcom isn't panning in the river. It's selling the shovels, sluices, and the roads to get there. Custom accelerators built to a hyperscaler's blueprint, Ethernet networks that keep tens of thousands of chips talking without choking, and a software stack via VMware Cloud Foundation that lets the biggest enterprises run private AI under real governance. Welcome back to the Capital Navigator, the channel where we peel back the layers of today's most powerful companies. Let's begin. The origins. From HP Labs to Consolidation Machine, the Broadcom you know today didn't appear overnight, is the product of 6 decades of invention and consolidation. Its lineage stretches back to a 1960s semiconductor group inside Hewlett-Packard that later became part of Agilent. In 1991, Henry Samueli and Henry Nicholas founded Broadcom Corporation to build broadband chips. In 2005, the Agilent chip division became Avago Technologies under private equity. And in 2016, Avago bought Broadcom Corp for $37 billion, took the Broadcom name, and kept Hock Tan in the CEO seat. It was, at that moment, the biggest deal in semiconductor history, and it set the tone for everything that followed: disciplined cost control, category-leading technology, and aggressive M&A. Under Tan, the playbook was clear: acquire category leaders, industrialize operations, and expand the portfolio where Broadcom could own critical picks and shovels. That approach took Broadcom's global semi-share from around 4% 2013 to nearly 30% 2018. The company added high-margin connectivity businesses, scaled up in networking silicon, and began to look past chips into the software running on top of the same data centers its silicon powered. Broadcom pushed beyond chips into infrastructure software, buying CA Technologies in 2018 for $18.9 billion, the Symantec Enterprise Security business in 2019 for $10.7 billion, and finally, VMware in 2023 for $69 billion. That pivot turned Broadcom into a two-engine conglomerate: semiconductor solutions plus infrastructure software. The business: 2 engines, 1 operating system. Broadcom's business model is a hybrid of high-performance semiconductor solutions and a growing portfolio of infrastructure software. This model is built on 2 main pillars: semiconductor solutions, approximately 58% of 2024 revenue. Fabless by design, Broadcom outsources manufacturing to foundries like TSMC, while focusing on advanced integrated circuit design, integration, and IP. Within this segment, the crown jewels: custom AI accelerators, XPUS and iZix. The fastest-growing segment, Broadcom sells engineering and IP to co-design chips with hyperscalers like Google, Meta, ByteDance, among others, helping them reduce dependence on general-purpose GPUs and lower long-term costs. Broadcom's share in custom AI silicon near 75%. Data center networking. Broadcom leads Ethernet switching with Tomahawk and Jericho families and routing silicon, critical for AI fabrics and large-scale cloud networks. That dominance makes the company an invisible backbone provider to hyperscalers. Wireless connectivity. The company designs high-performance connectivity chips like Wi-Fi, Bluetooth, and combo chips for premium devices like mobiles. It's a key supplier to high-volume customers like Apple, which represented roughly 20% of its revenue in prior fiscal years. Infrastructure software, approximately 42% of 2024 revenue. This segment was built through a series of strategic acquisitions: CA, Symantec Enterprise, VMware, giving Broadcom a portfolio of mission-critical software with established customer bases. This business model focuses on generating stable, recurring revenue through subscriptions for large enterprises. The flagships: private and hybrid cloud. With the VMware acquisition, Broadcom became a leader in virtualization and private cloud management software. Its flagship product is VMware Cloud Foundation, VCF, a platform that helps companies modernize their data centers and manage workloads, including AI workloads in a controlled environment. The strategy is to simplify VMware's product portfolio and transition customers to a subscription model, focusing on its 10,000 largest accounts. Cybersecurity. With the Symantec acquisition, Broadcom provides enterprise security solutions to protect endpoints, networks, and data. How it fits together. The chip engine sells high-performance components to a small set of huge customers. The software engine collects steady, subscription-like cash flows from large enterprises. Both run on a shared operating philosophy: cost discipline, focus on top accounts, and relentless product execution. The strategy that has been working for the company can be summarized as acquire category leaders and industrialize them. The company scaled by buying crown jewel assets, CA, Symantec, VMware, then aligning them to a strict model for cost and ROIC. Prioritize the biggest customers on Earth: hyperscalers, Apple, Fortune 500 IT buyers. In fiscal year 2024, the top 5 end customers represented roughly 40% of net revenue. Run lean, defend margins. Post-deal, Broadcom optimizes aggressively. One reason adjusted EBITDA margins have clocked in the mid-60s% in recent quarters. Build a cash machine. Free cash flow has reached extraordinary levels, 44% of revenue in Q3 2025, giving Broadcom ammo to pay down debt, fund R&D, and return capital via dividends and buybacks. The numbers: growth, profitability, and a cash engine. Over the past few years, Broadcom's revenue stepped up from the mid-30 billions to $51 billion after absorbing VMware and riding a wave of AI-related demand in networking silicon. Semiconductor cycles are cyclic, but the addition of infrastructure software pins a larger part of the P&L to recurring patterns, renewals, seat counts, and long-term enterprise agreements. Gross margin has remained strong overall, fluctuating as mix changes and as non-cash charges from large acquisitions flow through GAAP results, passing from 67% in 2022 to 63% in 2025 so far. Operating margin in the high 30s to low 40s has been achievable even as the company absorbs integration costs, thanks to the operating model's focus on big accounts and high-value products. Consider a recent quarter, Q3 2025. Broadcom posted $15.9 billion of revenue, growing 22% year-over-year, 67% gross margin, 37% operating margin. Adjusted EPS $1.69 versus $1.66 expectation, and a record $7 billion in free cash flow with a 44% free cash flow margin. With a dramatic growth in the AI semiconductor segment and advancement in the adoption of the VMware Cloud Foundation, shifting from perpetual licenses to subscriptions, the combined result is precisely what the company wants investors to see: secular growth in AI silicon plus durable cash from software. Broadcom projected $17.4 billion for Q4 2025, above street estimates, and raised long-term AI expectations, projecting that AI revenue growth to run significantly faster, helped by that $10 billion for its custom AI chips, with a client that is widely believed to be OpenAI. That program is important not only for dollars, but for proof of capability. It signals Broadcom can deliver integrated systems, not just chips, when a hyperscaler asks for a turnkey rack. This news sent the stock soaring 9.4% in a single day, reaching a new all-time high. Despite its incredible performance, Broadcom's valuation is a major point of debate among analysts, with many considering it demanding or elevated. The company trades at very high multiples, which are significantly above its historical averages and the sector median. The model is exceptional, a cash machine that funds R&D, deleveraging, and shareholder returns. But the market knows it. Its price-to-earning ratio of 88 compared to its 5-year average of 58 and a sector median 31. Its enterprise value to EBITDA ratio of 50 compared to its 5-year average of 24. Its price-to-cash flow ratio of 62 compared to its 5-year average of 25. These high multiples reflect the market's extremely high expectations for future growth. The bull case is clear: leadership in Ethernet switching for AI data centers, with new generations shipping at a rapid clip. A commanding share in custom AI silicon, reinforced by a $10 billion rack-level program that signals deeper integration. A VMware franchise aligned around VCF, with the largest 10,000 enterprises moving to subscription on a standardized stack. A cash engine capable of deleveraging while funding R&D and still returning capital. But there are also significant risks. Customer concentration. A handful of hyperscalers drive outsized revenue. Any pause, reprioritization, or competitive switch could bite. Custom ASICs face structural margin pressure compared to the higher profitability of general-purpose accelerators produced by NVIDIA. Broadcom's role, by design, is to deliver these solutions at scale in a way that saves customers money. Rising competition, from other custom silicon providers to incumbent switch vendors, pressing on price and share. Non-AI cyclical segments, such as broadband access and certain storage components, tend to recover slowly. This dynamic limits blended growth during downturns. At its core, the debate comes down to two things: speed and scope. Can Broadcom continue delivering complete systems, not just components, while holding on to its leadership in networking and migrating VMware's customer base quickly enough to justify a premium valuation that assumes flawless execution? The AI narrative, a two-pillar strategy that fits the moment. Broadcom's bet on AI has been a master strategy. The company is not competing directly with NVIDIA in the general-purpose GPU market. Instead, it is focused on two highly profitable pillars: custom AI accelerators and high-speed networking for data centers. Broadcom's business here is not selling a catalog chip. It's acting as a key engineering partner for AI leaders like Google, Meta, and OpenAI, helping them design their own custom AI processors, the front-end and back-end design expertise, and a foundry-ready blueprint for 3nm today and 2nm chips next. This allows its customers to reduce their reliance on NVIDIA and lower costs in the long run. The latest evolution is the rack-level delivery model. Broadcom doesn't just co-design the chip, it integrates boards, modules, interconnects, and firmware into a complete rack that can be ordered, shipped, installed, and brought online on a defined cadence. On the networking side, Broadcom is the dominant leader in providing the Ethernet switch chips that connect thousands of GPUs and XPUs. As clusters expand toward hundreds of thousands and eventually millions of accelerators, the network is the bottleneck. Its Tomahawk and Jericho families are the industry standard for expanding data networks. They make it possible to scale up smoothly, from within a single server rack, across multiple rows of racks, and even to connect entire data centers. Its bet is that an open, proven standard like Ethernet will prevail over proprietary protocols. Together, custom XPUs and dominant Ethernet switching form a moat that's part technology, part supply chain, part account strategy. The company isn't trying to be a vertically integrated AI platform. It's trying to be the architect and supplier behind the platforms that already exist, putting Broadcom in the diagrams of Google, Meta, and others. What to watch? Ethernet versus proprietary fabrics. If Tomahawk and Jericho continue anchoring the largest clusters, the moat deepens. If proprietary stacks win, the thesis weakens. VMware Cloud Foundation expansion. Management notes greater than 90% of the top 10,000 customers already purchased VCF. Watch renewals, AI/private cloud attach, and operating margins. Evidence of additional hyperscalers adopting the rack model or existing customers expanding programs reduces risk. Keep an eye on competitive bids from rivals in custom silicon and data center switching. Margins and FCF resilience. Sustaining approximately 67% gross and high 30s to low 40s operating while keeping free cash flow robust would quiet skeptics. Broadcom's edge isn't flash, it's fit. The company builds what hyperscalers and global enterprises need right now: custom compute that bends cost curves, Ethernet fabrics that scale, and private cloud software that keeps critical workloads governed. That mix creates a business with software-like cash generation and semiconductor-class growth, and puts Broadcom at the center of the AI supercycle. It's not risk-free. Customer concentration, competition, and a demanding multiple will keep pressure high. But if Broadcom keeps shipping racks on time, rolling out ever-faster Ethernet, and migrating VMware's giants to VCF, it remains an indispensable architect of the world's AI infrastructure. What do you think? Is Broadcom's strategic position as the architect of AI infrastructure a safe bet? Or does its sky-high valuation and customer concentration make it a risky investment? Let me know your thoughts in the comments below. If this deep dive helped you see Broadcom's playbook more clearly, tap like and subscribe. Your subscription genuinely helps the channel grow and enables more long-form, documentary-style breakdowns like this every week. Thanks for watching. See you in the next one.